I'm going to go back to David Kelly and ask you the simple question. Here's another three-quarter point hike. We haven't had back-to-back hikes of that magnitude as long as I've been in the business of covering financial markets, David, as I recall. I can't remember another time. If so, it must have been the early 80s. But is this the peak rate hike that we're likely to see in this rate hiking cycle, which is not to say we're not going to have more rate hikes, but do you expect more 75 basis point rate hikes as we move into September, November, December?
No, that's exactly the point, Tyler. I think we're seeing peak inflation and peak rate hikes. These two back-to-back 75 basis point rate hikes in June and in July, I think, will be the highest rate hikes we get in this cycle. I think in September they can back off to 25 to 50 basis points. And the reason for that is I believe both the July CPI number and the August CPI number will be in the range of sort of 0 to 0.2%, much milder inflation coming off the back of these lower gasoline prices in particular. And I think slower economic growth is a reality by the time you reach mid-September. So I think next time the Fed raises rates only 50 basis points, but obviously they're still being aggressive right now.
Well, pretty muted reaction so far. Bob Bassani and Rick Santelli join us to look at the markets, guys, in this early few moments as we digest it. Rick, let's start with you and remind everybody that the 10-year prior to the Fed's last move 6 weeks ago was at 3.5%, and here we are still sitting around 275 or so.
You know, and that is the key. If you look at where 2-year note rates and 10-year notes were on the 15th, which is when the Fed made its move, okay, of 75 basis points the last time, everything peaked on the 14th. As a matter of fact, if you look, 2-year note yields right now are down nearly 40 basis points from their 347 high close, and the 10s are down over 72 basis points from their high close. Both their high closes were the day before the tightening. So the Fed's big 614 was to send a message to the market. The markets have been tightening financial conditions, doing the heavy lifting, but something's changed. Since then, the market has loosened credit conditions pretty much on every level you look at. And that is the quandary right now. Many believe, large institutional traders, that many big hedge funds are going the other way. They're going along with the Fed, who's supposed to be the big inflation fighter, and they're saying the market moves of late are wrong. They're saying they're wrong. If you look at the Dow's up, what, over 5.5%, the NASDAQ close to 10% since the 615 meetings. So the real issue here is, if the markets are wrong, then today is a great day to sell and watch everything go down in stocks, and a great day to sell to watch all rates go up. But that doesn't seem to be happening. And the big question is, why? I don't think the markets are wrong. What I think is that everybody's underestimating the recession issues in Europe and the manufacturing deterioration that most likely will happen in Europe. I really do think that the reason our markets are counterintuitively trading has much more to do with the issues outside the U.S. and energy. Does anybody out there really think that Putin is going to let Germany and Europe stockpile enough to get through the winter? Isn't that the whole point of what he's doing, is to make sure that doesn't happen? I think there's going to be a bumpy ride ahead, especially for Europe, and I think that's why our markets are moving in the wrong direction. So say the big shorts, who think the Fed has to be tougher and that this press conference is going to be much tougher because the markets are doing a no-no. They're ignoring what the Fed is trying to do.